Welcome to The Explainer. Today, we're looking at a stock that, honestly, on paper, it looks like an absolute masterpiece. We're talking about SEI Investments, ticker symbol SEIC. But beneath this pristine surface of record-breaking numbers hides a massive secret, a paradox of red and green flags that the mainstream financial media is just completely ignoring. Okay, let's dive into this, because the central question we really need to answer today is exactly that. What happens when a perfect company is perfectly overpriced? We have a fascinating situation on our hands where incredibly high quality is colliding head-on with a very, very dangerous premium price tag. To figure that out, here is our roadmap. We're going to cover the paradox, 7 green flags, 7 red flags, the master frameworks, and the final verdict. Part 1. The SEI Investments Paradox. Record highs and hidden lows. $12.57 billion. That is SEIC's massive market cap. They provide investment management, administration, and advisory services to both institutional and individual investors. And for those who have held the stock, it's been an incredible ride, delivering a staggering 79% 5-year total shareholder return. I mean, they're managing hundreds of billions of dollars. Sounds incredible, right? And this brilliantly illustrates our paradox. On the one hand, we've got record Q2 revenue of over $641 million and massive adjusted earnings growth. Wall Street absolutely loves that, but under strict GAAP accounting rules, actual bottom-line net income declined by almost 14%. So revenue is going up, but expenses are rising even faster, causing actual profit to fall. It's a massive contradiction. Section 2. 7 overlooked green flags. The bull case. If you are looking for top-tier quality, prepare for some serious FOMO, because this company sounds practically invincible. Let's rapid fire through these first 4 flags. First, a guru-focused score of 99 out of 100, literally implying the absolute highest outperformance potential possible. Second, a 27.59% return on equity. But the real so what factor here is that 60.3% gross margin. That proves they have massive pricing power. It means customers are willing to pay a premium without defecting to a competitor. Third, it meets 8 of 9 Warren Buffett criteria, which is incredibly rare. And fourth, a pristine balance sheet. We're talking over $421 million in cash and virtually 0 debt. And the green flags just keep coming. Flag 5. An analyst consensus of buy from 8 analysts polled by S&P Global with $115.86 average target. That's roughly an 11% upside. 6. A strong buyback program resulting in a 2.65% share count reduction over the past year. When management shrinks the share count, it directly boosts the earnings per share for you, the investor. And 7. High ownership. Institutions hold around 72%, and insiders hold nearly 8%. Management has serious skin in the game. On paper, it's a flawless bull case. But here comes the plot twist. Section 3. 7 hidden red flags. The bear case. $195.7 million. Just let that massive figure hang in the air for a second. That is the exact amount of stock that corporate insiders dumped in just 3 months. Executive vice presidents are aggressively liquidating shares using their personal funds. This isn't just routine stock compensation, folks. These are aggressive sells, and the insider confidence signal is currently rated as very negative. Now, what's really interesting about this is the convergence of these warning signs. Despite that shiny 99 out of 100 score we saw earlier, Guru Focus actually triggered 5 warning signs. We already covered the declining net income and the insider selling, but look at that PEG ratio of 2.02. The PEG ratio measures price relative to growth. So a ratio of 2.02, that means you are currently paying over $2 for every $1 of expected growth. That is exceptionally steep. Rounding out the red flags, number 5, the stock is down 25.4% year-to-date. Tastefully ironic, isn't it? A stock with the highest outperformance score is somehow down a quarter of its value this year. The market is actively pricing in risk. 6, the valuation is highly expensive across the board, trading at nearly 18.5 times its earnings and 5 times its book value. And finally, 7, a sluggish 5-year revenue compound annual growth rate of just 4.6% simply might not justify those premium price tags. Let's move to and see how this builds in Section 4, the Master Investor Frameworks, putting SEIC on trial. First up, the moat. And the verdict here is a narrow to wide moat. SEI has incredibly strong defensive walls. They boast a 17.1% return on invested capital. Their proprietary tech platforms and deep client relationships create incredibly steep switching costs. Basically, once an institution is running on the SEI ecosystem, it is very hard and very expensive for them to pack up and leave. But here is where our experts completely diverge. We ran SEIC through 3 master frameworks. Benjamin Graham, the father of value investing, fail. It only meets 3 of 7 criteria because the valuation multiples are just way too high for a defensive investor. Peter Lynch's growth at a reasonable price, also a fail. That PEG ratio of 2.02 in an EPS growth rate below his 15% minimum completely kills it. But Warren Buffett's framework, strong fit. Buffett's model absolutely loves high-quality metrics like that 17.1% ROIC and those massive gross margins. It meets 8 of his 9 criteria, failing only on revenue growth. So the crucial point is how these different philosophies view the current price tag. The actual stock price is floating around $104, but the Graham number, which is Benjamin Graham's ultra-conservative fair value estimate, is sitting way down at just $43.65. The stock is trading at 2.4 times its defensive fair value. That leaves basically zero margin of safety for traditional hardline value investors. Which brings us to Section 5, the final verdict: reconciling quality and price. How do we balance this exceptional, undeniable company quality against this frankly dangerous premium price tag? Here is the ultimate recommendation breakdown. If you follow Benjamin Graham or Peter Lynch, this is a hard pass. The valuation is a deal breaker. It's priced for perfection. If you follow Warren Buffett or prioritize quality and momentum, it's a strong consider, because finding a company with 0 debt and 60% gross margins is rare. But for the general value-conscious investor, this is a watchlist stock. You want to wait for a pullback to the 85 to 90 range, or wait to see if that sluggish 4.6% revenue growth can actually accelerate before committing your hard-earned capital. Because as Warren Buffett himself so famously said, price is what you pay, value is what you get. This quote is honestly the ultimate summary of the SEI Investments paradox. You are getting incredible value in terms of company quality, pristine balance sheets, and a durable moat. But the price you have to pay for it right now, it's at an extreme premium. So I'll leave you with this final crucial question. Does SEIC's undeniable quality actually justify its premium price tag? That is the puzzle you have to solve. Keep digging into the numbers, keep researching their tech platforms, and decide for yourself if you're willing to pay up for perfection. Thank you so much for joining me on this explainer, and I'll catch you on the next one.